Okay, so we're now starting our second 15-minute interval. And we're talking about adjusting entries, the accrual of unrecorded expenses. And this is pretty much a very basic entry that's talking about liabilities and the related expenses that may increase with the passage of time. And three great examples that we'll talk about here are wages, interest, and income taxes. And importantly, the implicit transaction that will be recorded with our adjusting entry is to create a liability and the related expense at the end of an accounting period to be able to, in this case, make sure we've properly stated our wages, our interest, or our income taxes. These adjustments are necessary again. We'll keep repeating this to be able to ensure the matching principles in line, and then subsequently an explicit transaction will happen to actually show the payment of that liability. Let's give a couple examples. Your company makes its normal wages during the course of a month for a payment for salaries of $500,000, and you get paid on the 28th of every month. And in this example, the total salaries for this company for the month of January, or from January, I should say, for that whole period, was $500,000. They recorded debit to salaries or wages expense, increased the wages expense by $500,000, and a credit to cash, decreasing cash by $500,000. But now, at the end of January, you still have 3 days of salaries that, in order to look at a balance sheet for January 31st or an income statement for the month of January, we really need to be able to have those additional 3 days of wages accrued. Even though we haven't paid them, we would otherwise be understating our wages expense if we didn't create a liability that in February we'd otherwise have to pay. So the adjusting journal entry to accrue those $75,000 in wages for the last 3 days of January would be debit or increase our wages and salaries expense for $75,000, and we're going to create a liability called accrued wages payable for $75,000. Now we're properly stating 31 days of salaries expense for the month of January. 28 days or $500,000 have already been paid, and 3 days or $75,000 still have to be paid. When that $75,000 actually gets paid, that would be an explicit transaction. Why? We have source documents. We'll have check stubs. We'll have all the salary and benefits related information to be able to accompany that payment. If we didn't otherwise record that adjusting entry, our liabilities would be understated by $75,000 and our expenses would be understated by $75,000, and hence our net income would be overstated. Again, emphasizing the importance of making sure we have quality and financial information that makes up our income statement and our balance sheet. Again, on the next payroll date, the company will pay off that $75,000 liability, which would be in that case, they would be crediting cash or decreasing cash because they're paying the liability, and they'd be debiting the liability account, which would effectively make that liability account now go back down to zero. Interest is very similar. Interest, of course, is the rent that you pay for borrowing money. Interest accumulates as time passes, regardless of whether you've actually paid interest or not. So if any of you have a loan for a car or a loan for a home, each month you make a payment, and some of that payment is principal, some of that payment is interest, and of course the interest elapses over time, and you're going to pay it over time. But at the end of an accounting period, whether you're the one that's borrowing the money or you're the one that has lent the money, you need to properly calculate the interest. In this case, since we are talking about unrecorded liabilities, you're the one that's borrowing the money. So in this instance, if your company borrows $100,000 on December 31st, 2012. And the terms of the loan require that you pay it plus 6% interest in its entirety 1 year later on December 31st, 2013. So if you think about that, loan is outstanding for 1 year, and you're going to pay 6% on that for 1 year. So, of course, the way to calculate interest is your principal times your rate times the amount of time that that principal is outstanding. So in this case, it's $100,000 times 6% times 1 year. There's $6,000 that you're going to pay in interest to borrow that $100,000. However, we need to be in a position where each month we record the expense of interest. So $6,000 in annual interest equates to $500 in interest each month. So each month that goes by, at the end of January, we're going to record an adjusting entry where we debit interest expense for $500 and we credit or increase a liability account called accrued interest payable for $500. If you then think about making that same entry at the end of February, March, April, May, all the way through the end of December, at the end of December, you'd effectively have $6,000 in accrued interest payable, and you'd effectively have $6,000 in interest expense. When you then pay down that accrued interest payable, you'd be debiting accrued interest payable for $6,000 and crediting cash for $6,000. Again, at the end of each month, your accounts will be properly stated and you'll avoid understating net income by not recording the proper interest expense. Okay. Income tax is the very, very same thing. As an organization, in each month you generate some portion of net income. Your total revenues minus your total expenses is giving you some net income. Of course, Uncle Sam is going to have his piece of that. And so income taxes will be the very same thing, where there's a specific tax rate, whether it's a federal tax rate or a state tax rate, that you're going to be paying on. And in turn, you now need to record a debit to your income tax expense account, which is an income statement account, and a credit to a liability account, which would be accrued taxes payable. And when you then make payments for your income taxes, of course, it just decreases that accrued income taxes payable account. The next area that we're going to talk about is the accrual of unrecorded revenues. So that is frankly just a mirror image of your unrecorded expenses. If you have a bank that has lent you money, you as the borrower have the interest expense, but the bank, who is the one that lent you that money, is going to have the unrecorded revenue, the interest revenue in that account. So an unrecorded revenue account, different from deferred revenue, because deferred revenue, you received cash but yet have not performed your obligation related to what that cash is related to. In an unrecorded revenue perspective, you've actually done what you need to do relative to your obligation to record revenue, but yet you haven't invoiced the customer, and so you don't have an accounts receivable, but in turn you now need to be able to record your revenue. Okay, so same thing, the bank loaned you $100,000, and at the end of a year you're going to pay that bank $6,000 in interest, but each month that passes, that bank has some portion of revenue that they've generated. So in this instance, they're going to record a receivable of $500, accrued interest receivable, and they're going to record interest revenue, an income statement account, for $500. Think back now to you, the company that borrowed that money, and we're going to jump back to that account for a second. You recorded interest expense for $500 and a payable account for $500. Now the bank, of course, loaned you the money and has the revenue. They're recording a receivable for $500 and recording the interest revenue for $500. So it frankly is just the flip side of that transaction. When, of course, they receive the payment of the revenue, that, of course, is the explicit transaction. They'll have the check for $6,000 at the end of December. They'll be able to match it up with their accrued interest receivable account, which, of course, increases for the 12 months of the year. And at the end of December, there's $6,000 sitting in there. Failing to do that again would understate your assets because you didn't properly record that receivable, and it would understate your revenues because you didn't record that revenue related to that 1 month that had passed, and hence net income would be understated. We've chatted a few times about ethics as it relates to accounting in general, and there's black and white areas, but many times there are gray areas, as we've talked about in the past. And it's the financial manager, the accounting, the MBA's responsibility to understand where that gray area is and to impose the right level of ethics for yourself and in your organization, knowing that the matching principle is a fundamental tenet of the accounting results that we want in quality financial numbers are very important so that any reader of the financial statements is getting an accurate portrayal of what has transpired when they're looking at the balance sheet or the income statement. We can quickly go through this, as I think it's easy to understand, in that if you're going to, have net income which is at an inappropriate level, either too high or too low, your assets are too low, or your stockholders' equity may be too low, you'd rather have a level of conservatism embodied in your financial analysis than aggressiveness, is probably the better way of saying it. So if you're overly conservative or just conservative on the margin, your net income may be marginally lower than what it should have. Perhaps you record a couple extra liabilities just in case something happens. And in that instance, your net income would be a little bit lower, and your stockholders' equity or your accounts payable or your accrued expenses might be a little bit higher. So hence your stockholders' equity might be a little bit lower. That's a better cause of action than to be overly aggressive and not record some expenses that you knew were going to happen, which is going to overstate net income. A reader of your financial statements and folks that are making decisions based upon your financial statements will be in a better position to make quality decisions if there's a little bit of conservatism embodied in your financial decision making rather than a level of aggressiveness. We're going to pause here as we're coming up on our second 15-minute interval, and when we jump back in for our third section, we'll be talking about cash flows as it relates to adjusting entries.